Good morning everyone and welcome back to Morning Markets here at True Potential. It's Monday the 18th of December. Today we're just going to reflect on last week. There was so much economic information to digest, it's worth looking back. A tremendous week for asset markets and it's worth reflecting on the drivers of that. So the first material economic print which drove market sentiment was US inflation for the month of November. Now, whilst the print came in line with market consensus, it confirmed this narrative of disinflation, that is, cooling price pressures. And if we look at just inflation momentum in the US, that is just the last 6 months of inflation prints, it confirms that inflation has not just halved in the US in the last year, but is likely to trend towards 2% next year. Now, we may not get towards or onto 2% exactly, but we're certainly moving in a constructive direction, and markets took great sentiment and heart from that. The second material mover for markets was the meeting of the Monetary Policy Committee for the US Federal Reserve. They first of all confirmed that there will be no further rate hikes in this cycle. They also substantially reduced their inflation forecasts for the rest of this year and for next year. And they also confirmed in aggregate that there's likely to be more rate cuts than was expected just a few weeks ago for the year of 2024. So in summary, a very dovish outlook from the Federal Reserve. And the third material economic print we had last week was producer price inflation. So whereas CPI is the inflation basket for households and consumers, producer price inflation can be thought of as something similar for corporates, companies, manufacturers. It measures the price of input into their industry. Now, this measure has slowed to zero. So this really confirms that we're seeing broad disinflation for all sectors of the economy. But importantly, this PPI print feeds into core inflation for the US, and of course it's core inflation, which is the official target there. And that likely confirms again that core inflation momentum in the US has slowed to zero and may actually surprise to the downside for the month of November. And in fact, it may make the new inflation forecasts from the US Federal Reserve look stale already. And in fact, core inflation in the US may begin with a 2 in December. And that may require the Federal Reserve to refresh their narrative again in the early new year. And this is all very constructive for asset markets as we can look beyond the inflation pressures of 2022 and we can think more constructively about a lower profile of interest rates for 2024. And of course, this doesn't just apply in the US, it applies for the Bank of England and for the ECB in the Eurozone. We are likely to see further downward surprises in inflation next year as the price pressures post-COVID really roll out of these measures. So it's very constructive for asset markets and it's what markets have been focusing on as they look ahead. So that's all today, but please join us tomorrow where we'll focus in on the Bank of Japan and their last update of the year. Thank you.